The Treasury Secretary of the United States just stood in front of Congress and said the words Clarity Act and this summer in the same sentence. Scott Bessent, the man who controls the financial machinery of the most powerful economy on earth, looked into the camera and urged the House and the Senate to get it done. And while he was speaking, while every word was being recorded and transcribed and broadcast across every major financial news network, XRP was bleeding. Red candles. Sideways action. Retail investors panic selling their bags into the void, convinced that nothing is happening, that the dream is dead, that they've been lied to again. And here's the part nobody is connecting. 25 years ago, a bill passed in the United States that almost no one read, no one cared, no one understood it. It was called the Commodity Futures Modernization Act of 2000. And within 10 years of its passage, it unlocked over $500 trillion in derivatives markets, an asset class that didn't even meaningfully exist before that pen hit that paper. It made the United States the undisputed center of global finance. It also planted the seeds of 2008. The Clarity Act is that bill, for crypto, right now, in real time, and what I am about to tell you is not being explained to retail investors the way it should be. Because if you understood what is actually happening in the chambers of Congress this summer, what the senators are quietly negotiating, what JP Morgan is publicly warning about, what the Basel Committee is being pressured to reverse, you would not be selling. You would be doing the exact opposite of what the crowd is doing right now. Let me pull back the curtain. Today we decode the single most important piece of legislation crypto has ever seen, and we connect it to the silent capital reallocation that is already underway behind the scenes. No hype, no moonboy fantasies. Just the data, the math, and the institutional signal that the noise is designed to hide from you. Let's jump in. Let's start with the hard truth. 95% of the people watching crypto right now are staring at the wrong thing. They are staring at the price of XRP. They are staring at the daily chart. They are watching candles and refreshing their portfolios and asking why nothing is happening. If you're wondering why the price isn't moving despite all this bullish news, you need to understand something fundamental about how institutional capital actually enters a market. Institutions do not buy what retail buys. They do not chase pumps. They do not FOMO into green candles. Institutions buy legal certainty. That is the asset. That is the unlock. Price is a downstream consequence of regulatory permission, not the cause of it. To understand why the Clarity Act is the single most important catalyst in crypto history, we must first understand what banks are actually prohibited from doing right now. In 2022, the Basel Committee, the international body that sets capital requirements for banks globally, imposed a 1,250% risk weight on digital assets like XRP and Bitcoin held on bank balance sheets. Let me translate that into plain English. A 1,250% risk weight means that for every single dollar of XRP a bank wants to hold, they must set aside roughly $12.50 of capital as a buffer. It is not a regulation. It is a de facto ban. No bank on earth will hold an asset under those conditions. It is economically impossible. This is why you have watched, for the last 5 years, every major institution build infrastructure around XRP without actually holding XRP. Ripple has acquired Hidden Road. Ripple has acquired Standard Custody. Ripple has built ODL corridors across 40+ countries. The plumbing is finished. The pipes are laid. The valves are installed. But the water has not been turned on, because the regulatory gate is still closed. The Clarity Act doesn't just open the gate, it rewrites the entire framework. And right now, this week, in real time, Senators Hagerty, Sullivan, Lummis, Moreno, Husted, and Budd are pressuring federal regulators to dismantle that 1,250% risk weight and replace it with what they are calling a technology-neutral capital framework. That is the language to watch. Technology-neutral capital framework. It means XRP gets treated based on what it does. Settlement, liquidity, payment infrastructure, not based on what bureaucrats labeled it 5 years ago. This is the move. This is the signal. And the retail crowd is missing it entirely because they are watching candles instead of reading letters. Let's do the math that the retail crowd ignores. In the early 2000s, the global derivatives market was approximately $100 trillion. After the Commodity Futures Modernization Act passed, that same market expanded to over $600 trillion within a decade. That is a $500 trillion expansion, triggered by a single piece of legislation that defined the legal status of an asset class. Not by innovation, not by demand, by legal clarity. Now apply that exact mechanism to where we are today. The total global crypto market is currently around $3 trillion. Analysts at major institutions, not influencers, analysts at trillion-dollar asset managers, are projecting that figure to reach $100 trillion within 5 to 8 years once tokenization unlocks. That is a 33 times expansion, and that is the conservative number. Here is the number nobody wants to say out loud. The total addressable market for tokenized real-world assets, stocks, bonds, derivatives, debt, real estate, commodities, private credit, is approximately $1.7 quadrillion. That is not a typo. 1.7 quadrillion, 1,700 trillion. And every single one of those assets when tokenized requires a settlement layer, a bridge, a neutral asset that can move value between chains, between institutions, between jurisdictions, instantaneously, with finality, at near zero cost. XRP was engineered for exactly this purpose. Not retrofitted, not pivoted, engineered. Now think about the supply side. There are 100 billion XRP in total existence. Fixed, capped. Roughly 57 billion are circulating. The rest are locked in escrow. Released 1 billion per month, of which the vast majority is relocked. Exchange reserves are sitting at multi-year lows. Now ask yourself this brutal question. If even 1% of that 1.7 quadrillion in tokenized assets, just 1%, flows through XRP as a bridge asset, you are talking about $17 trillion of value attempting to settle through a network with a fixed supply of 100 billion tokens. Do the division. I'll wait. This isn't a prediction. It's a requirement. If you have a problem with that math, you don't have a problem with me. You have a problem with the laws of supply and demand. While retail investors are panic selling because the price isn't moving fast enough, the institutional signal has never been louder. Look at what Scott Bessent, the Treasury Secretary, actually said. He didn't just mention the Clarity Act in passing. He said the Trump administration is moving forward with all deliberate speed on the Digital Assets Initiative. He explicitly urged the House and Senate to pass it. He framed digital assets as a matter of economic security, which he then connected directly to national security. That is not bureaucratic language. That is the highest priority framing the United States government uses for any policy initiative. Now look at who is pushing the Capital Framework Reform. Reform 1. 6 United States senators, all of them on relevant committees, sent a formal letter to federal banking regulators demanding that the 1,250% risk weight be dismantled. They are not asking, they are pressuring. And they are citing the March guidance from regulators themselves, stating that tokenized securities should receive the same capital treatment as their underlying assets. The principle is already established. The framework is already being written. The pieces are already on the board. Now look at what JP Morgan, the largest bank in the United States, is doing. They are publicly warning that the window to pass the Clarity Act this year is narrowing. Ask yourself why a trillion-dollar bank is publicly applying pressure for a piece of crypto legislation to pass. Banks do not lobby for things they cannot profit from. Banks do not warn about timelines for legislation that doesn't affect their bottom line. JP Morgan is positioning. Their warning is the tell. And ask yourself one more question. Does Senator Lummis, who has spent her entire political career on digital asset policy, go on national interviews and confirm momentum from the White House and the Treasury without absolute confidence that this is happening? She does not gamble. She does not speculate. She is communicating institutional reality to the market in plain language, and the retail crowd is not listening. This isn't retail FOMO. This is calculated positioning by the architects of the next financial system. Quick pause. If any of this is landing for you, hit the like button right now. Subscribe if you haven't. Drop the word clarity in the comments below if you made it this far. I want to see who is actually paying attention versus who is just scrolling. The algorithm rewards comments more than anything else, and the more this video spreads, the more people get the truth instead of the noise. Now let's keep going, because what comes next is the part that actually changes everything. Let me walk you through the calendar that nobody on financial television is laying out for you. The Clarity Act markup was completed on May 14th. It passed out of the Banking Committee on a bipartisan vote. That detail matters more than people realize, because bipartisan exits from committee are the single strongest predictor of floor passage in the United States Senate. The original target was July 4th, American Independence Day. Symbolically perfect, politically aggressive. Realistically, the calendar is tight. Congress goes into recess from June 27th through July 12th. That gives the House and Senate roughly 3 working weeks before the recess to release text, debate, vote, and reconcile. Possible but tight. The more probable window is the August recess deadline. Congress works from July 13th through August 7th. That is a 4-week sprint to finalize the bill, push it through both chambers, complete reconciliation, and place it on the president's desk before everyone leaves to campaign for the midterms. After August, the political calculus changes entirely. Senators in contested seats will not want to take controversial votes heading into re-election season. If it doesn't pass before August recess, the next realistic window is post-midterms, And that pushes everything into 2027. This is why JP Morgan's warning matters. This is why Besant is urging speed. This is why the senators are simultaneously pressuring banking regulators on the capital framework. They are all racing the same calendar. The Clarity Act of Summer 2026 is the final green light. It's the moment the legal risk premium that has suppressed XRP for half a decade evaporates. It's the moment banks can finally hold XRP on their balance sheets without being capital punished into oblivion. It's the moment the wait-and-see money becomes the all-in money. The fuse is lit. The countdown has begun. And most people don't even know what they're watching. We are moving from an era of abundance to an era of scarcity. And this transition is happening right now, in the silence between news cycles, while you are being told that nothing is happening. Exchange reserves of XRP are sitting at levels we have not seen in years. Tokens are moving steadily, quietly off exchanges and into institutional cold storage. And here is the brutal truth about institutional custody. Once a token enters a multi-signature institutional vault, it does not come back to market for a 10% profit. It does not come back for 50%. It is gone. Removed from the float. Removed from the supply available to retail buyers. Forever. Think about what happens the moment the Clarity Act is signed. The regulatory risk premium that has kept XRP artificially suppressed for years collapses to zero overnight. The 1,250% risk weight gets rewritten into a technology-neutral framework. Banks that have spent years building infrastructure around XRP can finally hold the asset on balance sheet. ETF approvals accelerate. Corporate treasuries begin allocating. And every single one of those buyers is competing for tokens that retail holders have already sold into weak hands and panic. When the final switch is flipped, the retail market will be knocked out of the buying window. You will not be able to buy whole tokens anymore. You will be buying drops, 1/1,000,000th of an XRP at a time. The institutions have spent years trying to shake you out of your position so they can take it. The red candles you are watching right now are not failure. They are the smokescreen for accumulation. They are the silence of a predator waiting to strike. The door is closing fast, and it does not reopen. I know it's tough to watch the chart do nothing while every bullish catalyst in history is stacking on top of each other. I know the headlines about delays and recesses and political negotiations create fear. I know the temptation to capitulate after years of waiting is real. But as an analyst, I am trained to distinguish between noise and signal, and the signal right now is screaming. While the masses are focused on whether the bill passes by July 4th or August 7th, the smart money is focused on whether it passes at all this year. And the answer to that question, based on the Treasury Secretary's public statements, based on the bipartisan committee vote, based on the JP Morgan pressure, based on the parallel banking capital reform, is yes, with overwhelming probability. Yes, being early feels exactly like being wrong, right up until the moment reality catches up. And the moment reality catches up, the window to position closes. It does not give you a warning. It does not send you a text message. It simply gaps. And the people who held through the silence become the people who own the new financial system. The question isn't whether the price will recover. The question is who will still be holding when the legal framework is signed. The capital requirements are rewritten, and the institutional floodgates open. The math has already decided who wins. The only variable left is whether you are paying attention. 25 years ago, a single bill unlocked $500 trillion in brand new markets and made the United States the center of global finance. That bill was passed almost without notice. The people who were paying attention, the architects, the institutions, the ones who read the actual text, captured the upside of a generation. Everyone else found out later, after the prices had already moved, after the positions were already taken. The Clarity Act is that moment, happening again, in front of all of us, in real time. The only question is which side of the table you are sitting on when it is signed. Price is a distraction. Value is the reality. One is a bubble, the other is a bridge, and history does not reward comfort. It rewards those who pay attention when the room is quiet. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete. I'll see you in the next briefing.